4.3. Analyse ROE, leverage and profitability. One of the accounting drivers of abnormal earnings is return on equity, ROE. We can analyse a firm's ROE by breaking it into three bits: leverage, profitability and efficiency. In this section, we'll focus on leverage and profitability. Breaking things into bits. Analysis involves breaking things into bits. When he was a child, my younger son was often curious about how different things worked. How does a keyboard work, or an old record player, or a watch, or a computer? He could not tell by looking at something from the outside, so he would take it apart and pull it to bits. Although he could often find it more challenging to put things back together again, breaking things into bits gave him some insights into how things worked. It is the same with financial statements. Are you curious about how a firm works? You can gain useful insights into how a firm works not by physically breaking a firm into bits, but by breaking its financial statements into bits. This analysis can give us insights into how a firm is or is not adding value to equity investors. We start with abnormal earnings, AE. As we have seen, AE equals ROE minus ROE minus 1, or times BV, book value. Another way of saying this is that abnormal earnings is driven by three things: ROE, return on equity, cost of equity capital, ROE, and the book value of ordinary shareholders' equity, BV. In this section, we'll start to analyse ROE by lifting the bonnet on the financial statements and taking them apart. The instruction manual on how to analyse or take apart return on equity is shown in figure 4.2. There are three aspects to this analysis: leverage, profitability and efficiency. If you remember anything from this study guide, remember figure 4.2. In many ways, it is at the heart of what we do in financial statement analysis. Leverage. I grew up in Sydney and spent 13 years as a student in the New South Wales school system in Australia. I attended 5 schools in Sydney: Clempton Park Public School, Burwood Public School, Enfield Public School, Strathfield South Public School and Newington College. I had some great teachers at various times and learnt quite a few useful skills, including reading, writing and arithmetic. The single most important thing I learnt was in one of my science classes in high school at Newington College. We learnt about leverage. It is theoretically possible to move the whole earth if you could have a long enough lever. A little bit of effort at one end of the lever can result in a multiplied effort at the other. This is leverage. As we can use physical leverage to move physical objects, so we can use financial leverage to use other people's money to make more money for ourselves. Leverage is a wonderful friend in good times, but can be a terrible enemy in economic downturns. Leverage of a firm can be calculated in a few different ways. For example, as total debt to total equity or total debt to total assets. If we have separated the operating and financial activities in a firm's financial statements, we are able to identify the operating and financial leverage of a firm. We can calculate financial leverage, FLEV, as financial leverage equals net financial obligations divided by equity. You will notice we use net financial obligations, NFO, rather than the more usual measure of total debt. In calculating net financial obligations, we have deducted from total debt any financial assets a firm might have. This is the actual measure of a firm's financial leverage.
Many analyses of leverage, however, do not consider another potentially important aspect of leverage, namely operating liability leverage. Financial leverage is a measure of the effect of financing some of the total operating assets of a firm by net debt through the debt markets, rather than by shareholders' equity. Operating liability leverage is a measure of the effect of financing some of the total operating assets of a firm by creditors, that is, by suppliers or customers, through the product and input markets. One is leverage because of a firm's financial activities. The other is leverage because of a firm's operating activities. These two aspects of leverage combine to reduce the amount of equity needed to fund a firm's business activities, and in this way acts as a lever on the returns a firm can provide to its equity investors, compared to the return it can earn on its operating assets. Financial and operating leverage mean a firm is not restricted to providing its equity investors with the return the firm can earn on its operating assets. Using leverage, it can provide its equity investors with a different, hopefully higher return than that gained from its operating assets. Let us see how these two types of leverage work for Ryman Healthcare. As at 31 March 2022, Ryman Healthcare had in place operating assets with a book value of $10,942.9 million. See Table 4.5. These operating assets comprise 45 retirement villages, including about 8,500 retirement village units and about 4,200 aged care beds. Retirement villages under development, as well as various other assets such as furniture and fittings, motor vehicles, and debtors. That is quite a lot of assets or resources put in place by the firm to generate value. These assets can generate value for customers, employees, suppliers, and the general community, as well as for equity investors. We are focusing on the value they can generate for equity investors. These operating assets of Ryman Healthcare, amounting to over $9 billion, did not simply appear out of nowhere. They have been funded in three ways, with resources contributed by equity investors, debt holders, and creditors. Based on Ryman Healthcare's restated balance sheet as at 31 March 2022, see Table 4.5, I've set out in Table 4.8 how the operating assets of Ryman Healthcare have been funded. As can be seen from Table 4.8, Ryman Healthcare has financed 45% of its operating assets by way of operating liabilities, 24% by debt, and 31% by equity. Almost half of the resources needed to fund Ryman Healthcare's operating assets have been provided by creditors through operating liabilities. In Ryman Healthcare's case, its creditors are primarily its customers. In most firms, creditors are usually suppliers. Operating liabilities are unusually high in the case of Ryman Healthcare. This is because customers of Ryman Healthcare make interest-free advances to the firm in exchange for occupation rights over individual retirement village units. These loans from customers funded nearly half of the value of Ryman Healthcare's operating assets. Net financial obligations, NFO, funded 24% of Ryman Healthcare's operating assets, a relatively modest proportion compared to many firms. The point I wish to make is this. Just as we are not physically limited to moving weights that we are physically able to lift by ourselves, but can use levers or pulleys to help us lift much heavier loads, so the returns firms can provide their equity investors are not limited to the returns generated by their operating assets. Firms can use levers, financial and operating leverage, to provide different and hopefully higher returns to equity investors than a firm earns on its operating assets. Firms do this by using the resources from debt providers and creditors to help fund a firm's operating assets and relieve equity investors from having to fund all a firm's operating assets themselves. The impact of leverage on returns to equity investors can be substantial. For example, in the case of Ryman Healthcare, its operating assets generated a return of 9.3% in 2022. Yet in section 4.1 above, we saw that Ryman Healthcare provided a return on equity, ROE, of 23.0% in 2022. How could Ryman Healthcare provide the return to its equity investors when its operating assets generated only 9.3%? Well, it did it through leverage. The impact of leverage on the returns a firm can generate to its equity investors is set out in the following equation or relationship. ROE, return on equity, equals return on operating assets, ROOA, plus, in brackets, return on net operating assets minus return on operating assets, close brackets, plus, open brackets, return on equity minus return on net operating assets, close brackets. Return on operating assets is the return on Ryman Healthcare's operating assets with no leverage. Return on net operating assets is the return on Ryman Healthcare's net operating assets, including the leverage effect of its operating liabilities. And return on net operating assets minus return on operating assets identifies the leverage effect of its operating liabilities. The difference between Ryman Healthcare's return on equity and return on net operating assets is the leverage effect of its financial liabilities. Ryman Healthcare's return on net operating assets, RNOA, was 12.8% in 2022. We can use the equation above to examine the impact of leverage on Ryman Healthcare's return on equity. Return on equity equals return on operating assets plus return on net operating assets minus return on operating assets, all in brackets, plus, open brackets, return on equity minus return on net operating assets, close brackets, which equals 9.3% plus, in brackets, 12.8% minus 9.3%, plus, in brackets, 23.0% minus 12.8%, which equals 9.3% plus 3.5%, plus 10.2%, which equals 23.0%. This relationship shows Ryman Healthcare was able to generate a return on equity for its equity investors of 23.0%, less than half of which came from the return it generated from its operating assets, 9.3%, and more than half from its leverage, 3.5% plus 10.2% equals 13.7%. About 1/4 of this leverage effect, 3.5%, was generated from operating liability leverage, using operating liabilities to leverage its return on operating assets, with about 3/4 coming from financial leverage, using borrowings to leverage its return on net operating assets. Leverage can allow firms to provide higher returns to equity investors than the returns generated by the firm's operating assets. But this is not the full story of leverage. To better understand the impact of leverage on equity investors, we need to understand the other two aspects of return on equity: profitability and efficiency. We will first consider profitability.
Profitability. I find in business, most people have a strong understanding of the concept of profitability. Most people have a clear grasp of the idea of profit margins, how much profit we make from each dollar of sales. There are several different ways of measuring it and looking at it, but the idea itself of selling something to customers for more than it costs, to buy inputs from suppliers and to transform those inputs in some way, seems clear enough to most people. Also, it is easy to grasp the idea that if you do not make an adequate profit margin, you will quickly go out of business. Indeed, the concept of a firm's profitability largely cuts to the chase in terms of a firm's ability to add value to equity investors. It is seen as in some way core to the activities of a firm. We define profit margin, PM, as profit margin equals operating income after tax divided by sales. The profit margin focuses our attention on the profitability of each dollar of sales. Clearly, the more profit a firm can achieve from each dollar of sales, the greater the value add to equity investors. The average profit margin in the US is about 6%, but can vary widely between industries and between companies within industries, and over time, depending on where we are in the economic cycle. For example, many firms can be expected to have profit margins more than about 10% or less than about 3%.
We can calculate Ryman Healthcare's overall operating profit margin for the year ended 31 March 2022 from its restated income statement. See Table 4.6 above, as follows. Profit margin equals operating income divided by sales, which equals 713.6 divided by 1,254.7, which equals 56.9%. Ryman Healthcare's profit margin of 56.9% is very high. For every dollar of sales it made, about 57 cents profit. There are not many businesses that can achieve profit margins like this. A significant proportion of Ryman Healthcare's operating income after tax, OI, in 2022 related to the fair value movement of investment properties. The market value of its retirement villages is related to the market value of residential properties in the surrounding areas of each retirement village. This is because Ryman Healthcare's customers generally purchase occupation rights by selling their homes. For this reason, a key part of the drivers of Ryman Healthcare's operating income is growth in residential property values. A key part of the story of Ryman Healthcare's ability to generate a return on equity of 23.0% lies in its ability to generate profit margins of 56.9%. However, it is only part of the story, and all parts of the story interact with each other. As I said previously, in business, I find most people have a strong connection with and understanding of the importance of profit margins in generating returns to shareholders. However, I often find much less understanding of the fact that profit margins are not of importance in themselves, but rather it is the interaction or combination of profit margins with efficiency, the amount of sales generated by each dollar of net operating assets invested in the business, that is critical. We will now consider efficiency, the remaining aspect to an analysis of ROE, return on equity.
4.4, Analyse ROE, Efficiency and Leverage Revisited. This section completes our analysis of return on equity. We will consider efficiency, the third aspect to an analysis of return on equity. We'll also revisit our previous analysis of leverage. Efficiency. Efficiency is how well net operating assets, NOA, in a business are being used to generate sales or turnover. Turnover is another word for sales. It is measured as the relationship between assets and turnover, called unimaginatively asset turnover, ATO. We define asset turnover as ATO equals sales divided by net operating assets. Asset turnover is the amount of sales generated by each dollar of net operating assets, NOA, in the business. It is the ability of net operating assets in the business to generate sales. Alternatively, asset turnover can be looked at as its inverse. 1 over ATO equals net operating assets divided by sales. The inverse of asset turnover, that is 1 over asset turnover, is the amount of net operating assets, NOA, needed to be put in place in the business to generate each dollar of sales. An average asset turnover in the US is about 2.0 times, but can vary widely between firms, with most firms having an asset turnover between about 1.0 and 3.0 times. Typically, a firm's asset turnover tends to be more stable over time than its profit margin, PM, although asset turnover can fall significantly for firms during economic downturns. A firm with an asset turnover of 2.0 times can generate $2 of sales each year for each dollar of net operating assets, NOA, put in place in the business. Or alternatively, 50 cents of net operating assets are used by the firm to generate each dollar of annual sales.
It is surprising how easy it is in business to overlook the importance of a firm's asset turnover, ATO. Yet, as can be seen in figure 4.2 above, return on net operating assets, RNOA, is driven by the interaction between profit margin, PM, and asset turnover, ATO. This can be expressed as follows. Return on net operating assets equals profit margin times asset turnover. This is the DuPont analysis of operating profitability, named after the major US manufacturing company that used this analysis in the early 20th century. We can calculate Ryman Healthcare's overall asset turnover, ATO, for the year ended 31 March 2022 from its restated balance sheet and income statement. See tables 4.5 and 4.6 above as follows. Asset turnover equals sales divided by net operating assets, which equals 1,254.7 divided by a half times, in brackets, 6,015.3 plus 5,116.3, which equals 0.23 times. Ryman Healthcare's asset turnover is low at 0.23 times. It can generate 23 cents of sales for each dollar of net operating assets the firm has in place in the business. This low asset turnover reduces the impact of Ryman Healthcare's strong profit margins, 56.9%, on its return on net operating assets, RNOA, 12.8%, and on its return on equity, 23.0%.
Indeed, it is usual for there to be a trade-off between profit margin and asset turnover. The higher the profit margin, the lower the asset turnover, and vice versa. For example, supermarkets typically make low profit margins on their sales, say about 3%, but generate a lot of sales from their operating assets. Asset turnovers of 3.0 times are not uncommon. In contrast, luxury car dealerships typically have much more substantial profit margins, say about 10 to 15%, but generate much less sales from their operating assets. Asset turnovers of 1.0 times or less are not uncommon. This inverse relationship between profit margins, PM, and asset turnovers, ATO, is shown in figure 4.3 below. All firms with the various combinations of profit margin and asset turnover represented by the line in the graph in figure 4.3 would earn a return on net operating assets of 10% per year. In most businesses, there is a trade-off between profit margin and asset turnover. As a firm increases its profit margin, its asset turnover tends to decline. And as a firm increases its asset turnover, its profit margin tends to decline. Averages, median, of the ratios of the various drivers of return on equity in US in 1963 to 1999 are set out in table 4.9 below. The averages can vary significantly across different industries and over time during different stages of the economic cycle. However, they give some guidance as to the order of magnitude of what might be typical ratios. As far as I'm aware, averages for these ratios have not been calculated in Australia and New Zealand. We've discussed the three aspects to an analysis of return on equity: leverage, profitability, and efficiency. We've seen profitability and efficiency interact to generate return on net operating assets, RNOA, and that in practice, in most industries, there is a trade-off between profit margin and asset turnover, between profitability and efficiency. In business, many have a good grasp of profit margin, but can often fail to fully appreciate that return on net operating assets, that is, operating profitability as a percentage of net operating assets, is not driven by profit margin, but by the interaction of profit margin and asset turnover. It is the interaction and trade-offs between profit margin and asset turnover that need to be the focus of managers' attention in running a business, and is a primary means for management to add value to equity investors. In the same way, many consider the effect of leverage to be driven by the amount of debt in place to help fund operating assets of a business. The more debt in place, the greater the leverage. We will now revisit leverage and see that leverage is not driven simply by the amount of net financial obligations, NFO or net debt, used to help fund a firm's operating assets. Leverage revisited. We saw earlier that financial leverage, FLEV, is the relationship between net financial obligations and shareholders' equity. To use the terminology of Barrow's 1660 translation of Euclid's Elements, FLEV, financial leverage, is the mutual habitude of net financial obligations and shareholders' equity, two important flatmates in any firm. We also saw that financial leverage levers the return on net operating assets, RNOA, into a return on equity, ROE. The relationship of return on equity and return on net operating assets can be expressed as follows. Return on equity equals return on net operating assets plus FLEV times spread. Operating spread is the difference between the return a firm can earn on its net operating assets, RNOA, and the cost to the firm of borrowing, net borrowing cost, or NBC. Net borrowing cost can be expressed as net borrowing cost equals net financial expenses divided by net financial obligations. Net borrowing cost can be readily calculated from our restated financial statements. The key thing to notice is that the difference between return on equity and return on net operating assets is not financial leverage, FLEV. That is the relationship between net financial obligations and equity, which is often called a firm's gearing. Rather, the difference between return on equity and return on net operating assets is FLEV, financial leverage, times spread. That is the interaction of financial leverage and spread. The leverage equity investors can experience in their return on equity compared to the return the firm is generating on its net operating assets, return on net operating assets, is driven by two things working together, only one of which is financial leverage. Operating spread is the difference between the return the firm can generate on its net operating assets, return on net operating assets, and its net borrowing cost. The greater a firm's spread, operating spread, the greater the leverage equity investors gain in terms of increased return on equity for each dollar of net financial obligations introduced into the firm. If there was no difference between the return the firm can generate on its net operating assets, return on net operating assets, and its net borrowing cost, NBC, the firm could increase its borrowings, NFO, as much as it liked, but it would generate no leverage between its return on equity and return on net operating assets. Leverage between a firm's return on equity and return on net operating assets depends on the interaction between FLEV, financial leverage, and operating spread, between a firm's level of borrowings and the profitability of its operations compared to its cost of borrowing. It is both working together that levers return on equity compared to return on net operating assets.
In 2022, Ryman Healthcare had substantial operating spread of 13.1%, calculated as return on net operating assets of 12.8% minus net borrowing cost of 0.3%. Note, Ryman Healthcare had net financial income in 2022 of $6.5 million due to a substantial positive fair value movement of cash flow hedge reserve, which means its net borrowing costs, NBC, of 0.3% is its net lending income. For this reason, we add 0.3% to 12.8% to calculate its operating spread. Both return on net operating assets and net borrowing costs are after tax, as both operating income, OI, and net financial expenses, NFE, are after tax in our restated income statement. Ryman Healthcare had an above average level of financial leverage, NFO, net financial obligations divided by equity, of 77.7%, which combined with its substantial spread resulted in its gearing having a significant impact on its return on equity, increasing its return on net operating assets of 12.8% to a return on equity of 23.0%, an increase of 10.2%. We have seen how to analyse the return on equity, ROE, of a firm into leverage, profitability, and efficiency. In the case of Ryman Healthcare, we have seen that its return on equity can be broken into return on equity equals return on operating assets plus, in brackets, return on net operating assets minus return on operating assets, close brackets, plus, open brackets, return on equity minus return on net operating assets, close brackets, which equals 9.3% plus, in brackets, 12.8% minus 9.3%, close brackets, plus, in brackets, 23.0% minus 12.8%, close brackets, which equals 9.3% plus 3.5% plus 10.2%, which equals 23.0%. In 2022, financial leverage played only a part in driving Ryman Healthcare's return on equity, 10.2%, that is over 4/10 of its total return on equity. With operating liability leverage also contributing to Ryman Healthcare's strong return on equity, 3.5%, that is about 1/6 of its total return on equity, as did its ability to earn a return on operating assets of 9.8%, that is about 4/10 of its total return on equity. We can see that Ryman Healthcare's return on net operating assets of 12.8% was primarily driven by a very strong profit margin, PM, of 56.9%, with a low asset turnover, ATO, of 0.23 times. Some of the key economic and business drivers of Ryman Healthcare's strong profit margin were strong development margins and limited growth in residential property values, which led to upward revaluations of Ryman Healthcare's properties. Strong demand for retirement village units. This is due to about 3% per year population growth in the 75 plus age group in New Zealand and Australia, and a growing proportion of people in the 75 plus age group in New Zealand, Australia, who wish to live in retirement villages. Ryman Healthcare's significant capacity to develop, own and manage retirement villages. In other words, Ryman Healthcare has the capacity to provide a significant stock of retirement village units to meet the strong market demand. Ryman Healthcare's ownership of a significant land bank of future development sites and its significant in-house property development and construction capability underpins its capacity to continue to strongly grow its portfolio of properties. Rate of turnover of occupation rights to existing retirement village units. Currently, existing residents in retirement village units stay in them for about 7 years before they either die or move into other stages of their integrated retirement village, serviced apartments, rest homes, or hospital care. Every 7 years or so, Ryman Healthcare is, on average, able to resell occupation rights to each of its retirement village units. These may have been a slight increase in the average. There may have been a slight increase in the average number of years residents stay in their retirement villages in recent years. High occupancy levels of Ryman Healthcare's retirement village units, serviced apartments and rest home and hospital beds. This relates to several factors, including overall market demand, as well as Ryman Healthcare's reputation, quality of service, and the effectiveness of its marketing. Ryman Healthcare has a stated policy of growing its earnings by 15% each year over the medium term, which it has been achieving or exceeding over many years, although the COVID pandemic has interrupted this to some extent. We've gained some insights into what was driving Ryman Healthcare's return on equity of 23.0%. First, we investigated some of the key accounting drivers of Ryman Healthcare's return on equity, and then started to consider some of the key economic and business drivers that might be driving or causing the level of Ryman Healthcare's accounting drivers, such as its strong profit margin. So far, we've only been looking at the past, a trip already taken by equity investors. No one ever got rich by analysing the past. Our only interest in analysing and understanding the past drivers of return on equity is to prepare us to ask a key question. How do we expect return on equity for a firm to change in the future?
Conclusion. This chapter has given us some ideas about how we can understand the past. It is possible to have a high degree of confidence about what happened in the past, if our sources of information are sufficiently reliable. The financial statements can help us to engage with what we know about a firm's economic and business realities. We've seen how we can restate a firm's balance sheet and income statement. This helps us to clearly separate the operating and financial activities of a firm and to identify a firm's comprehensive earnings and book value of ordinary shareholders' equity. Comprehensive earnings, expressed as return on equity, and book value are two of the three aspects we need to identify to be able to calculate a firm's abnormal earnings, i.e. The third aspect is cost of capital, which we will look at further in Chapter 6. We also analysed a firm's return on equity, ROE, by breaking it into leverage, profitability, and efficiency. We have seen that the past is a trip already taken, and it is a trip easier to understand and analyse than the future, which is a trip yet to be taken, a path no one has yet trodden. Understanding the past is of no value by itself. Its value, however, is in providing a starting point to answering the central question of financial statement analysis: how the key drivers of the past could be expected to change in the future. Everyone is wise after the event. Few have the wisdom before the event. This study guide is about helping us to start to develop the capacity to have a degree of wisdom before the event, to be able to make our own assessments of the value of a firm based on our own analysis of its financial statements and of other information about a firm. In the next chapter, we will look at how to use our understanding of the past of a firm to better predict its future. This is what we will need to be able to do if we're going to assess the value of a firm. Also, in the next chapter, we'll focus on forecasting a firm's enterprise, not its equity, economic profit and cash flow. That's its forecasting a firm's enterprise, economic profit and cash flow. We will do this by choosing to focus solely on a firm's operating activities and not on its financial activities.